We are, of course, getting into the heart of earnings season. BlackRock's Rick Reeder, he was with me yesterday on Closing Bell. He said the setup remains really good. Listen.
I think there's a couple things at play. One, you've got an economy that's operating at a pretty good level. I mean, just printed, or we think you printed second quarter GDP at 3.8. Third quarter, we think is running 3.3. You got an economy that's operating at a pretty good level. And you've got a Fed that's got to bring rates down. And you've got a dynamic where corporate earnings are pretty good.
All right, that's Rick Reeder. He lays it out, Jason Snipe. Economy good, rate cuts coming, earnings are going to be good. Is he right on the money?
I think he is, Scott. 86% of companies have beat so far this year. Now, the earnings beat rate is slightly lower than the industry average at 8.5%. So the beat rate has been about 5.9, I should say. What I'm excited about going forward is their earnings story for the rest of the index, right, the 493. So if we look at the Mag 7 earnings growth this year, it's about 15% into this quarter. The rest is looking at 6.7%, but going into Q3 of 2026, that number starts to converge, looking at 19% Mag 7 earnings growth to 15% of the others. So for me, I like the breadth story that is starting to get some oxygen, and that's why I continue to like this market. We're always focused on earnings here.
You like the Reeder story?
I love the Reeder story.
You agree with that?
100%.
Earnings, economy, rate cuts?
100%. We're running
AI investing, Mag 7, CapEx.
Yeah. I mean, yes. The economy is growing at 3.9%, actually, the Atlanta Fed tracker most recent number. It is certainly helped by AI, but the consumer is also doing their part. Look what Coke just reported today. They guided for 5 to 6% organic revenue growth. That's huge. They said the consumer is fine. Low end, not so much, but that always is the case. What's also interesting to me, Scott, is that not only do we talk about consumer has jobs, they've got wages, now you're starting to see commodity prices actually come down. Gasoline prices are down 18% year to date. Food input costs are starting to come down. Even home prices in certain pockets of the country, namely the Southeast, are coming down. Rents are coming down. All of this is really good for the consumer. So I'm not in this camp of AI is generating all of the growth, and if we didn't have AI, we would have 0% growth. I think it's consumer and manufacturing, AI, and the renaissance that's happening there. And yes, we do have the Fed that's starting to cut, QT going away at some point. And then, yeah, I mean, earnings have been really good so far. The banks were off the charts. I know we're going to talk about that. Mm-hmm. The big six off the charts.
Speaking of commodities, it's worth noting today, gold's getting hammered. It's the worst day since 2013. Take a look at that. Silver getting crushed. That's a considerable story, too. I mean, you don't see gold down 5% that often. Silver is a bigger decline of almost 7%. That's the worst day since April. So I gave you the Reeder readout, if you will, of all the good, right? And people know the good.
Yep.
There is, according to some, though, a lot of froth around the edges.
Okay.
Bank of America talks about that today. They don't say it's in the core as they look at the core, but around the edges. Look at the gold stocks. Look at nuclear stocks. You can look at gold stocks year to date. Those gains are crazy. GDX up more than 100%. Newmont up 132, and so on and so forth. Nuclear, Oklo's up 600%. Is there a problem in a certain part of the market with too much froth that needs to come out? Has the run-up in gold been too dramatic, and some of the other metals, like silver?
It becomes a problem when the market does not efficiently correct the over-speculation and maybe to a certain extent the excessive leverage. What is going on today in the precious metals is exactly what you want to see happen. It is healthy.
A self-correct.
The value of the U.S. dollar has risen so far month to date. The dollar is up again today. Let's talk specifically about the precious metals.
Let's do it, because Newmont's the worst stock in the S&P 500
down
today.
9%.
And that's yours.
Okay, down 9%, the context of a much larger appreciation for the course of 2025. But it doesn't feel good today, okay? Why is gold experiencing what it's experiencing? Number one, without question, you have reached a moment in precious metals where you could define the environment as having excessive speculation. No doubt about that. Right. Here's the evidence to support it. Last Thursday and Friday, the GLD options market did 2 million shares on each day. That's a historic record. In addition to that, volatility in the precious metals is at its highest level since 1979. And this is all happening without what is required in the commodities complex, which is your weekly commitment of traders report. You're not getting that from the CFTC because of the government shutdown. So no question, you have excessive speculation, and that is correcting right now in the precious metals, but it's healthy. The fundamental, the secular bull market for precious metals remains in place, and on a pullback, if you do not own precious metals, you want to make sure you get an allocation to it.
All right, Farmer Jim, how do you see things as you're digging around your property, hoping to strike gold and other metals that might be under the tundra of the Lebenthal Ranch?
I feel pretty good about things. I do. I mean, I think the thing that we're answering all these questions in a context of a market that's had a heck of a rally, whether it's year to date or 3 years. You know, I'm sure everybody on the panel takes a lot of calls from clients saying, doesn't this market have to go down soon? Isn't it too expensive? Look, those comments can be true, but it still means that the market can go higher and probably will go higher. It's hard to sell in this environment if you're a professional money manager. You don't want to take the risk of getting behind your benchmark, or if you are behind your benchmark, you're desperate to catch up so any dip gets bought. If you're a retail investor, you don't want to take capital gains right now. And so all the fundamentals we've been talking about combined with that technical picture to tell me that we're likely to rally into year end. Can we get a pullback? Sure, but they've been bought so quickly that I don't think you're going to get more than a 3% pullback. One last comment, because Stephanie and Jason, you both talked about earnings. Let's remember the earnings estimates in aggregate coming into this quarter were not really revised downwards, and there was a certain concern that maybe that was too high a bar and maybe it wouldn't get cleared. Well, so far it is getting cleared very nicely, as Jason and Stephanie pointed out. The bank's metrics across the board, especially credit delinquencies, pretty darn good.
Anybody care about what Torsten Slok over at Apollo has been talking about, especially as it relates to the Russell, that unprofitable stocks are beating profitable ones?
Yes.
Really started to diverge as you got into the beginning areas of the fall. As you see, they're sort of hand in hand. And then as you get into September, you have a bit of a divergence there. Negative EPS starting to rise, whereas positive EPS was starting to fall. Absolutely,
you're concerned about that, because if there's not a handoff to quality, then you have the setup we had in 2021 all over again. I'm actually encouraged by what we're seeing so far in the month of October, where, as I mentioned yesterday, quality is outperforming once again. Quality is up in the month while momentum is down. So on a day like today, we are highlighting the correction in some of the speculative areas of the market that have rallied so significantly. You're seeing that the quality factor, again, is stepping forward today, and volatility is down once again today. So you go out, you could buy that insurance. So I don't think that we could have ever expected that the non-profitable companies would continue to be the hallmark of what this secular bull market is. There has to be a handoff at some point to quality, and I think we're at the early stages of that, and I think that's going to be the theme in 26.
What do we think?
You know, I think, to Joe's point, I think we do need some balance here. I think part of it is obviously the cutting cycle that is underway, which is giving some oxygen to the speculative favor that you're talking about. So the names that we've been talking about, obviously, this week and over the past couple of weeks is what's going on in biotech. A lot of unprofitable names in that sector. However, the M&A cycle, I think, is going to really get some fuel going into next year. So I think you just have to be, you have to really evaluate the whole picture and understand the narratives to really understand what's going on under the surface.
I think at the end of the day, after earnings season, quality will win out. But it's so early on right now in terms of earnings season for quality companies. So I think, but eventually they will shine. And not only will they shine on earnings, but they're going to shine on margins. Margins are going to accelerate from here. And that's why I'm so optimistic. That's because the economy is growing, and that feeds right into earnings, and that feeds right into the margin story, which is operating leverage for the earnings picture.